Good evening everyone and welcome to Admiral Markets webinar of 3rd of December 2014. My name is Nenad and today we will delve a little bit deeply into stop hunting. You know, all these things which were happening and have happening with forex banks, with major central banks, with retail traders, and all of you probably know that I've published an article which basically was all about how those fixing work and how basically fixes at 1 p.m. and 4:15 p.m. Killed some stops. And today I will definitely explain what is a stop hunt, who are stop hunters, should you be afraid of stop hunts, how to protect yourself, and all those things. These things which I will be talking about are basically from my perspective, and yeah, there is a link to my article. Definitely there is a link to my article. I will provide you with the link, so no problem. That was a good one. Now I can show you now, I guess. It's also, I think it was also published here on Admiral Markets, but let me just search for it and I will give you the link for all of you who basically didn't have the opportunity to read through that article. And it was basically on daily forex. I will just find a link for a second and then I will show you the link. Okay. Let me see, where was that? Just half a minute. I cannot see it here now, but yeah, definitely I will find it. Yeah, I think it's somewhere on daily forex, and it was also published. I think it was published here on my blog, but I need to find, I just cannot find it now, but definitely it was there. Let me find an, yeah, here. It was also on my blog here. It was on my blog, but it was also on Daily Forex, so you can read it here. I will provide you with a link on our Forex blog. Here on Forex blog. And it was also done on, as I said, on Daily Forex, I think, website, so you can read it here, definitely. Those were some things which I was trying to point out, because I know that many traders really are afraid of those stop hunts and such things, and we definitely need to learn how to protect ourselves. So I will be talking about that today. I hope that it will be interesting. So let's start. Online educational materials are available by Admiral Markets Estonia for a global audience. Therefore, please take into consideration that the information in this session may not be suitable for everyone. To get a corresponding information on charting conditions in any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Risk disclosure statement stating all possible risks associated with Forex market. By accepting this risk disclosure, you are also proceeding further with me. Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author, it's me, and in no way it represents the actual suggestion for the trade. These are not MUK's opinions, and the website in the video is not the .co.uk website, but the globalnews.com website. Forex is risky business, and this is a personal opinion only. This webinar is for informational and educational purposes only. So today, stop losses. Just for our newcomers, a quick view of stop losses. What are stops? What do they represent? Then stop hunts, protection, examples. That is today's agenda, okay? So what is a stop loss? All of you know what is a stop loss, and basically the basic definition of a stop loss is it's an order which limits investors' potential loss on a forex position. It's known as a stop order. My definition is stop loss is stopping a loss. That is basically even more basic than this definition. So stop loss means stopping your loss. So that is very pretty much thing, when we close a sell order, it is on an automatic buy into the market. When we close a buy order, it's an automatic sell into the market. It goes like this, guys. You don't see that on your platform. But when you close a sell order, when you close it, it means that it is automatic buy into the market. Your platform closes by giving it a buy, and vice versa. And it happens behind the curtain. And basically, the thing is, when we see such strong news, you remember my analysis today, dollar CAD. After the analysis, dollar CAD came to the price, POC, and it jumped 40 pips after hitting our entry. What happened then? That is why I always suggest that you also follow me on Twitter, because I post analysis on Forex Factory, Forex Street, and Admiral Markets blog. After that, let's say that I need to do an update, I basically make it on Twitter. And today you saw the analysis for dollar CAD, and I was warning you about GDP, and no, that was for Australia. For dollar CAD, it was Bank of Canada statement and overnight rate. And what happened is, after the market jumped 40 pips, it dropped almost 60 pips. And basically, those are the things which we need to be very careful about. For example, you were long, and you put your stop, but you forgot to close your price because you were maybe a little bit greedy, and you wanted to squeeze more than 30-40 pips. What could have happened is that the price hit your stop loss, but it wasn't closed at your stop order. It was closed a little bit below it. That's called slippage, and it can happen when market is very volatile. But of course, it's up to our brokers and liquidity providers to stop, to basically stop such a behavior of the price. And presumably, when we trade the price, we want to see the price moving as we projected it. Stop loss means stopping the loss. That is why it's called stop loss. Okay, stopping the loss. Remember that. Advantages of using stop loss. We are protecting our equity. That is the most important. It is of utmost importance to protect our equity. Why is that so important? I hear that many traders basically do not know how to trade because they don't use stop losses. The thing is simple, guys. Let's say that you, for example, open an order for example, just you want to sell euro at 2350, 2350. Okay, that is your sell order, right? The thing is, how you know how big your entry position will be? How can you determine what will be your volume traded, your lot size? For example, you're pretty much sure that it will go down from this level, but how many lots you will put in this sell? Most people know, okay, probably it will go down, and they put one lot, okay, and their account is, let's say, 10, or let's say $1,000. So one lot is equal, on euro dollar, is equal to $10. So what can happen? Yeah, it might go down, definitely. But that trader who opened this position definitely does not know how to trade, because your initial lot size is always calculated according to your stop loss. Remember that. That is how you will be successful trader. That is how you will manage your equity and your funds safely, guys. You know that I'm very serious about this job. You know that I'm very passionate about this job. I wouldn't teach you something that is nonsense. If you have $10,000 account and you want to put one lot, you need also to calculate your risk. It doesn't matter if you trade with $1,000 or $10,000. It's the same, because risk for a trade should be anywhere between
0.3 to 0.5%. That is the risk. So if you put $1,000 on $1,000 one lot and you don't put your stop loss, that means that you're risking the whole account because you don't know if the price, where the price will stop or not. You will be doing mental stop. When you see that your equity is fading away, you will stop it mentally. You will be disturbed. You will enter a spiral of doom. So the first thing which you need to do is you open your sell at 23.50 and you know, because you're following your system, method, a mentor, a forex analyst, that your stop loss is 23.80. So you have 30 pips to your stop loss. Now, according to your account equity, you need to calculate your risk. If you put 0.3, that would be basically $90 of a risk. Is it acceptable on $1,000 account? Well, basically, it's again too much. Is it acceptable for $10,000 account? Yes, it's acceptable. It's okay. It's only $90 on 10,000. It's not much, right? So it's good. It's okay. Even though it's a little bit more than 0.3 to 0.5, it's still okay. It's okay. But the first thing you need to do, you need to protect your equity. Then you need to make money. The first thing as a professional forex trader you want to do is protect your equity. Protect, guys, your equity. Not making money comes after it. Okay? My Twitter handle is TarantulaFX, so you can follow me definitely. TarantulaFX, my Twitter handle. Now, this explains why it's very important to use your stop loss. Okay? It's not just about protecting your equity. It's about how much volume you trade, and it's always based according to your stop loss. So you're trading you trade based on your stop loss, not based on your target price. If you don't use stop loss on leverage trades, it will end your career in forex market. Let's say that you have $100,000. Then you don't need to use the leverage. You don't have the leverage with $100,000. And let's say that you open $1 position. Guys, opening $1 position, it's equal to 0.1. Basically, okay, it's too small for $100,000, but if you have $100,000 account, I don't think that you will open $1 position, because definitely if you do that, it might be an investment. For example, you will take out the profit in 2 or 3 years. Okay? But the thing is, if you use leverage, then you need to know that leverage can end your career as a forex trader if you basically do not use a stop loss. Also, the advantage is quick exit of the trade when it goes below or touches the stop loss. It will give you the peace of mind, because you are trading with a low risk. You don't have anything to be scared about, anything. Is this connection proof? Let's say that you suffer from a blackout in your apartment or in your office, and you didn't put your stop loss, and you don't have your mobile platform close to you. Now what would you do? You would be sweating. You will be very nervous. This connection proof is putting your stop loss. It's also platform malfunctioning proof. If something goes wrong with your platform, don't worry, your stops are basically put on the server, so it doesn't have anything to do with your computer. Now, disadvantages of using stop loss are more of psychological nature, because psychological failure when stop loss hits, it's always unpleasant. Even if you use a low risk, it's always unpleasant to see that your stop is hit. You don't feel very good about your stop loss being hit. You're basically a little bit of shaken, even though if it's a very small position. yet alone, for example, a big position with a huge leverage, it's really 10-20% in a single trade. Also, disadvantages, you need to know where to put your stop loss. You need to know when to exit a trade. You need to know when to trail stop. If it's placed in a wrong place in time, that is definitely not good for you and for your account. And if you continuously want to trade with small stops, the probabilities are it will get hit multiple times and you might suffer a debt of 1,000 cuts. So you might be basically, for example, one stop loss is hit 10 pips, then 5 pips, 7 pips, 8 pips. That is called debt of 1,000 cuts. You don't do that. And normal trading today is not about putting 10 pips stop loss. Put it 30, put it 50, put it 100. But your risk should be the same. And I just don't like when traders are bragging, I made a 10 pip stop loss and I'm aiming for 100 pip profit. That's stupid in my opinion. Because it's the same. If you use 10 pip stop loss, the odds are your stop will be hit, especially if you use high volatility pairs. But let's say you use 20, 30 pip stop loss. It's the same as you were using 100 pip stop loss. As long as your risk is 0.3 to 0.5. It's the same, it doesn't matter. The only draw side of that, the only disadvantage is basically that you won't be making big money with it, obviously. If you use 100 pip stop loss, that means that your risk is pretty much small and your entry is not, it's usually very small. So you should be aiming for, 100 pips, 150 pips, and it might take some time. If you're intraday trader, most optimal is that you use, I use usually 30 pips stop loss, and for each $10,000 account, I trade 0.3. That is for me optimal. And of course, if you don't have the experience in trading yet, then you should use a little bit lower, let's say 0.2 or 0.15. What is now, let's talk about stop hunts. So first, we need to distinguish what is a stop hunt. A stop hunt, in my opinion, is basically triggering stop orders of other traders for someone's benefit. Okay? That is my definition of a stop hunt. So let me repeat it again. It's the triggering of stop orders of other traders for someone's benefit. That means stop hunt, and that is a stop hunt in my opinion. Stop hunt is done by stop hunters. Those are people, traders, who have the ability to move the market like a bank or big money or hedge fund, pension fund, and they need liquidity to dump their position. So those are stop hunts and stop hunters. So that is a person, an institution, a bank or hedge fund which has the ability and to move the market, and he needs liquidity, or it needs liquidity to dump their position. Usually those stop hunters are contrarian traders, basically who are looking to liquidate the position into these stops. As I already explained you a couple of slides ago, for each buyer there must be a seller as long as the market is driven by supply and demand, okay? Because you know that usually, and that is the truth, if you win, someone is losing. If you lose, someone is winning. So that is a zero-sum game. So let's say that stop hunters will always attempt to trigger the stop orders of other traders for their own benefit. They always have the ability to move the market by a small degree for a short period. Stop hunter might be a bank, big player, pension fund, hedge fund, important institution, central banks are not stop hunters, definitely, but usually that can be some big player, big money, real money. But it can also be a forex broker's dealing desk, which is trading in competition with its customers. I know that Admiral Markets does not do that, but there are some brokers dealing desks which are basically trading in competition with its customers. Usually those brokers who are doing that have the disclaimer, which explains that sometimes they can trade versus their customers. It can be a large player, bank, pension, hedge fund, institution, whatever. For example, there is a typical trading situation. I will give you here a quick example. Then we will go later to the charts. For example, you know that dollar-yen will go up, and you want to buy, let's say, at 120.00, and your stop loss is 190.70. Okay, it's normal. So you open the long position at 120, and 119.70 is your stop loss. Okay, let's say that at 119.80 was a double bottom. For example, you saw a double bottom, and it's pretty much justified by your system. It's also justified by price action because you see double bottom, and you are definitely sure that this pair will go at least to 120.50 or 121, for example. Now the thing is, the trade goes and starts to go against you and breaks through support. Your stop is hit 70, and you're out of the trade. Now you think, wow, this will go down. Now, wrong. You know what happens next. After taking out your stop at 70, maybe the price will go a couple of pips below, then it will turn right back and head north. So the pair will move at 140, then 100 and 121, 122, and so on and so on. So basically, you might start to think, if I only had a stop set just a little bit lower, is it really a bad luck? I think it's not a bad luck. Guys, remember now what I will be saying. Stop hunting always works finest when the majority of traders' positions are inclined to the one side of the market. That is when stop hunting are definitely working the best. Now, if you remember my Euro-Swissie analysis just before the gold referendum, I was simply buying each dip of Euro-Swissie to 12000. Why was I doing that if I know these things? Guys, because SMB is not stop hunter. SNB is major player in Forex market. Remember that. Swiss National Bank is the major player in Forex market. And it doesn't go like that. Stop hunters are much smaller than central banks and especially SMB. I can say that SMB is at the top of the food chain of the Forex market. The bank is very, very strong. It's the central bank. So those things are done by other institutions, big money, person, hedge fund. When you have, let's say, market sentiment pretty much at extreme point, those top hunters will be placing their, let's say, their orders in contrary to most of the market. And the thing is, you as a trader will definitely be placing your stops at obvious level. Let's say you're long at 120.00, double bottom. Of course, most obvious is to place 5 pips below double bottom. When stop hunter is aware that that majority of the market is below the line, bang. Okay. Now I'm still talking from the point of a good central bank such as SMB, but there were other banks which were not central banks. Those were commercial banks which spiked price, hunting the stops of retail traders to their own advantage. That is the article I was talking about. I was basically stating that those were the banks, and those banks were fine for that. But major central banks will not do that. And now there are, again, many options to protect you from those kind of things. Those banks which dealt with those top hunts in near past. Definitely, it was a major article on ft.com. Those banks now are making additional supervising technology gadgets to supervise all of those who have the possibility to move the market. So it should be basically, it should not happen as it is happening these couple of years. Especially this was true in year of 2007, 8, and 9, when regulations were pretty much worse than they are now. So the thing is, guys, if you are long, let's say if you are long, it's normal that you put your stops below most recent swing low, but that is why I'm always saying try to use trailing stops. Try to use, guys, trailing stops, okay? Now, the thing is, for example, you can also buy back from stop hunters. So let's say that you're going long at this price and your stop is hit. Now what stop hunter will do, it will buy back from this level, knowing that it had the possibility to move the price 10 pips to trigger the stops, and when those positions are liquidated, basically he or it is buying at that point. So basically you're buying along with stop hunter, and basically he will be spiking the price again to be a bit more than the price was at the time when he sold it. So that is buying back from a stop hunter, okay? Now the question is, which usually arises, is does your broker, guys, does your broker hunt those stops, okay? I think that most of us trade with other markets. So far that hasn't been the case. That wasn't the case really so far. The thing is, that was the case some time ago, back in mid 2000s, and basically many new traders are very confused about this particular subject, okay? Many new traders, and even traders who are in this business, have the idea that a broker hunts your stops. It was the case, okay? It was the case some time ago, but today it's very risky, guys, for a broker to push the market with artificial pricing to trigger your stop. Because if they do that, they will be caught in an arbitrage, and that is pretty much punishable. They will have several legal repercussions and penalties, okay? In the opinion, let's say what I think, usually there are two possibilities how broker may hunt the stop, and each of these options is very dangerous if broker engages. The thing is, retail stops are seen, they can be seen by your broker, but if the broker is honest, broker won't do that. Broker can push the artificial price to your feed in order to hit your stop loss. But if you take in consideration the risk of the broker, and that the broker can lose their license if they're caught doing that, you know that they will be out of business. Especially when there are strong regulations, such as in UK, European Union. So you can see that. It's very easy to compare your data feed with another trader's data feed from the same broker, and see the let's say the discrepancy between the price. You can also see that, for example, you can see artificial price of the broker. But again, you need to take account the risk of the broker. If broker is doing that, that will be definitely the arbitrage, and that will be there won't be the possibility for the broker to hedge their exposure. So definitely I think that serious brokers today are not doing that kind of job. And I really think that other markets do not engage in such an endeavor. It's very risky. The thing is how Ian Fleming said with James Bond, once is accident, twice is a coincidence, 3 times is an enemy action. Okay? Once is accident, twice is coincidence, and 3 times is an enemy action. So that is my opinion why serious brokers just do not do that. So guys, you shouldn't be afraid if you're trading with admiral markets. Now, the thing is we need to take other things into account. It's called stop loss triggering or stop loss grabbing. And there are 6 steps of stop hunt. About stop loss triggering, that is pretty much most obvious. If you traded long at 120.00 and stop is triggered at 190.70, once the stop is triggered, the price may go down to 120, sometimes even more. Most of major banks and forex players are trading on round numbers. That is why you usually see that the price is rejecting of the round number. So if these things happen, you know that there was a probable stop hunt and stop triggering afterwards. Okay, that is not the same thing, stop hunts and stop triggering. Stop hunts are always preceding stop triggering, because if stop hunts if stop is being hunt, there is a big possibility that the price will trigger stops and go with the momentum of stop hunt in that desired direction. Price will cascade, market will not reverse, it will continue to trigger those stops, accelerating the move because new traders will also join the ride. Okay? Stop hunt is the initial bullet. Then it goes stop triggering, then there is a momentum, and finally there are new traders who want to have a free ride. That is why price, once stop is hit, can travel pretty much to the downside. That is why it's good always to use your stop losses. Okay? Now there are basically 6 steps of stop hunts. The first step is the institutional traders wait for the prices to hit, let's say, in this our example, support level. Okay? That is the first step. The second step is they enter orders to purchase a large volume of currency. Because the trading volume is low, the large buying order will cause market prices to shoot down past the support. Are you following me, guys? You have the support and volatility is pretty much thin. That is why I don't like to trade when there are bank holidays. Low volatility can trigger stop hunts and stop triggers. So the institutional big money, let's call it big money is waiting for the prices to, let's say, come close to 190.70. Now when price is making very close, when price is trying to test this level, they will enter orders to purchase a large volume of that dollar-yen currency. Because we have bank holidays, there are no central banks to defend the levels and so on, the large selling order will cause the market prices to shoot down past this support. Now all the poor traders who place their stop losses few pips below the support will get stopped out. Okay? Next step, step 5, because their stop orders are hit, the price will continue to go even higher, hitting more of other traders' stop losses. Now, the institutional traders are selling the currency because everyone else will be looking to sell, and prices are likely to go back down again since all the buyers have already been exhausted. It's called covering. I will show you that also on a slide. So these are the 6 steps. Waiting for the price is the first step. Second step is entering orders close to support or resistance. Third step is shooting up or below resistance or support. Fourth step is all traders who have their stops above that resistance or below that support, a couple of pips, will be hit. Price will continue to move. That will give momentum to the price, and step 5 will hit more and more of those stop losses. Step 6 is basically that institutional traders are also in the right and they are looking to sell, where buyers are covering. How to protect against these things? For me, the most important thing, how to protect myself, is, as you know, heavy usage of trailing stop. Back in time, I wasn't using trailing stop, guys. But today, in these market conditions, I have been hit couple of times, and I just don't want to be hit again. Sometimes, as you know, I will make that example. And guys, you know that what I'm talking about. This is where I was hit also. But the price, you know, this was caused by those banks. Those are not central banks, mind you. Those are banks which have manipulated the rates. HSBC, JP Morgan Chase, Citigroup, Royal Bank of Scotland, UBS, Bank of America. Read these, guys. They were accused that the traders at different banks met in online chat rooms and worked on trading strategies, particularly in the moments before the fix was determined. I strongly suggest you that you read this article, guys. Please read this. Tweet your friends. Share this. This is very, very, very... a question. Mike, can you help those of us in US translate to our time zones for times in article? It can be confusing. Definitely. Times, please, Central European time, Mike, is GMT. Now it's GMT +1. So please use converter. Central European time is GMT +1. Okay? 4 p.m. Central European time. 4 p.m. GMT +1. 1:15 GMT +1. Please use time zone converter. Okay? And it's very easy to use. So how would I do that? I will explain for all of you who are, and we have people from USA here. I'm glad, really. So GMT to PST converter. So what you should do, Mike, and all of you who are trading in USA, Greenwich Mean Time is 8 hours ahead of Pacific Time. So GMT to Pacific Time converter for USA, Canada citizens. Please use this table. So GMT, okay? GMT and PST, okay? And now what I was trying to show you is, if it says 1:15 Central European Time, it means 1:15 GMT +1, okay? CET is GMT now. At this time, saving is GMT +1. On summer, it will be GMT +2, but now it's winter time, so pay attention, okay? Okay? And read through this article, okay? Now, let's get back to slide. Use trailing stop. Place stops above obvious retail traders. If you, the primary thing, guys, is use trailing stop. This second thing can be okay, but if you place your stops above obvious levels, that means that you need to use a wider stop, so you won't be using 30. Maybe you will be using 60 pip stop. But the thing is, if you use 60 pip stop within the same risk ratio, then you will obviously need to use a lower lot size. Instead of making 0.5 or 1 lot, you will be doing with 0.2 or 0.3. So that is up to you, guys. Yes, it's a good thing to place stops above obvious retail traders. So if you see double bottom, then don't place it 5 pips below double bottom, place it 50 pips below double bottom. But then it's most obvious that you will be using also lower volume trading, lower lot size. So it's up to you. I personally prefer to use trailing stop. Always use low risk. Don't forget the tripod of successful trading. What I've been teaching you all this time. First thing is to protect your equity. Second thing is to make profit, guys. Protect your equity, and then at the later stages make your profit. So the thing is, low risk will keep you safe. Is it bad if you earn 2 to 5, 6, 7, 8% in a month? It's great, because banks will give you 1 or 2% per year. And if you're able to make 2% per month, then you're basically 12 times better than banks. You're doing it perfectly. Some suggest Fibonacci's, round numbers. I know that those things don't work. Let's say that you made your entry at 50% Fibonacci and you want to put your stop loss at 88.6, just below it. It's the same as being, basically as you're trading with obvious retail traders. Round numbers. Those stop hunters know that there are basically a lot of orders placed around the round numbers, okay? So trailing stop, once your trade is in a profit, put your trailing stop. I know what your system tells you, 15 pips, 20 pips, 30 pips, or after 15, 20 pips, put your stop loss to break even, or take scale out, do whatever you you need to do in order to protect your profits. Use low risk. Don't trade with 2% per trade. 2% per trade is too much, in my opinion. Even though if you have good risk to reward and a good system, trading with 2% per trade is way too much for my liking. From time to time, I can do that, but don't forget that I am a professional trader. So if I do that, I know that I will manage that loss if it hits me. But if you're not sure about your trading capabilities, guys, please use low risk. I'm a professional trader. I use low risk. Sometimes I can raise my risk a little bit higher, but that is only sometimes. 90% of the time, my risk is also low. Okay? Now, this is the spike which happened, and this was a clear sign of manipulation. Look at those spikes. This was a major stop hunt. This was a major stop hunt. This was obviously the most recent level, and traders knew that those stop hunters knew that at this point, if the price hits, there are many stops which will be collected to the upside. Fixed time. Look at the time, guys. It's 15, but it's 15 on our platform. So it's full spike. Look, it's 4 on our platform. Look at this candle. This candle is a spike candle. It's 4 o'clock, guys. Full spike. Clear sign of manipulation. Clear sign of manipulation, guys. Now, please read this article. That will explain you about those fix. Okay, I will read through this to explain you a fix. In order to efficiently evaluate a currency pair, we need to understand the so-called fix. Each pair price is fluctuating on a daily basis by a huge number of pips. The fix presents benchmark rate, which measures the value of currencies related to each other. Let's say GBP to dollar, New Zealand to dollar. Interestingly, the fix happens at a specific time of the day. Most widely followed fixes are Reuters fix and ECB fix. Okay? Now, it's all explained here. That is the fixed time. That is fixed time. Okay? And those are when manipulations are done. Now, look at this. Next day, stop hunt again. Look at the candle time. 12, and this is 1 hour candle. And look what happened. At the fixed time, look, they hunted the stops, and of course, what I was trying to tell you this webinar, they cleared the stops, look, because they knew that there were stops down there. And then the price, look where the price ended. Look where the price has ended. That is what I was trying to buying back from stop hunters. If this happens, guys, you need to understand this was the major support. when these things happens, stops were triggered, this is stop hunt, this is stop triggering. And later, it's buying time. Very easy to spot, right? And look at the time. Add 1 hour to this. Also one example of stop hunt. 2013. Look, this is also a good example of stop hunt. 37.00 was the price. Look where the price moved. It made a nice U-turn, but then bang, couple of pips to the upside, clearing some stops. That was not enough, but look at here. Stop hunt, stop triggering. And of course, later, look how good this example is. Stop was triggered here because most of the traders were basically searching for a short opportunity. Look at this. Stops were triggered here. Then majority of retail traders joined the ride. And look what happened. U-turn. Technically, the price should have turned at this point. But no. The stops were triggered and the price went down subsequently. Okay? So you need to know that usually, I will explain, let's say I will use this example to further explain, okay? So Euro definitely at this time tried to hit 37.00 level. Now, you being a retail trader, typical trader, knows that yearly high for Euro was basically at 37.00 and normal retail trader would place stop just above 37.00. Now, stop hunter knows that retail stops are usually around 37.00 and that entity or major player decides to spend 20 to 30 millions of capital to move the market towards 37.00. Okay? And that happens. That happens. That happens, guys, at this point. It's only after the retail trader is stopped out and the profit on the trade can be booked. Only when the trader is stopped out. Okay? So those stop hunters are also traders. And then can make mistakes. They try to manipulate through S&B, but they failed. You know how they failed. They were trying basically to push the price below 20.00 floor, and they failed. And S&B also was very determined to defend the floor, and they failed. And that's good they failed. I like it really a lot. So the thing is, always pay attention to these kind of things. Use the trailing stop, protect yourselves, use low risk. If you use low risk, you will be definitely protected. Even though if it happens, you will be protected. But still, there are better times for Forex industry. Don't be afraid, because this was secret, right? And now we all know what happened. We all know what happened. So guys, don't be afraid. By using these steps, which I gave you, pretty much simplistic steps, you can protect yourself. You can protect your equity. And still, those banks will use new technology to prevent those things happen. They will be fined. Maybe they will go to jail. But it won't be so often, I presume. Lowest risk of stop hunting is prefix time. Usually during, I trade usually after Frankfurt fake. Frankfurt fake is, I cannot call it stop hunting, but Frankfurt fake is, you need to distinguish, guys, between stop hunting and stop triggering. Stop hunt is not the same as stop trigger. For example, the price is, let's say, having a retracement, and most logical level, let's say, is this level. And when the price hits this level, it should retrace. What can happen is the price may go a little bit above this level, because majority of traders place their stops here. It doesn't necessarily mean when price is spiking that there is a stop hunt. I explained you. Maybe there were some stops which were triggered and then price went down. It doesn't necessarily mean that there is a stop hunt. I avoid Frankfurt session. I just don't like Frankfurt fake, and I don't like to place any trades around London noon. I wait for London Open, New York Open, Asia Open. Remember guys, the best trades are done the first 3 hours of each session. Okay? First 3 hours of each session. US European overlap. Mike is asking, is there a high or low risk of stop hunts? Mike, there are no stop hunts using when you're trading US European overlap, because usually US news will kick in 30 minutes after US opens. It's 2:30 my time, 2:30 GMT +1. They will be waiting for the news, but my suggestion is that you open the trades just after those news. So if you're a US citizen, you will be having news around 2:30 GMT +1. I don't know which time is in USA then, but it's 2:30. Just go on Forex Factory. It's 2:30 my time, 2:30 GMT +1. And usually I open trades after that time. And I can trade London, first 3 hours of London, but usually strongest news are in USA, so I usually will open trades 30 minutes after the first news. Okay? I just joined the webinar. The information is the same. It's not the same as my article. It's different, because in this webinar I was showing how to protect yourself from stops, what are stop hunts, what are stop hunts, what are the steps, 6 steps of stop hunts, what is the logic behind stop hunts, and so on and so on. But read through the article to get the basic idea, of course. So guys, try to place orders first 3 hours of each session, excluding US session. Best time for US session is 30 minutes after the news, guys. 30 minutes after the news. It is the best time for US session, okay? My suggestion is buy Euro Swiss close to floor. If it goes down, buy it. Try to book some profits. Tokyo Open is good. Yes, no, there are no stop hunts during Tokyo Open. I didn't, very often it happens that I trade, back in time I wasn't trading during Tokyo, but sometimes if I go to sleep a little bit later, I might open some trades at Tokyo Open. Usually my trades are pretty much good if I close it before Frankfurt fake. Okay, so don't be afraid of those stop hunts. Basically, you won't be seeing that very so often. This is not a stop hunt. This might be basically that some stops were triggered and then the price basically was rejected. But this is stop hunt. Look at this. This is stop hunt. This is stop hunt. Okay? Do stop hunters may catch high volatility moving NFP big news first candle? Usually not, because NFP news are not for stop hunts. Usually you don't trade first candle. You know how to trade NFP. You need to wait for a retracement. You need to wait for a retracement. I don't trade binaries. I never trade. Mike, I don't suggest that you trade binary options. Binary options are gambling. So please stay away from binaries. I know that some of my friends traded binary options and they gained, for example, one person gained $400 in 1 hour and he lost everything in next hour. So I don't like binary options. That is not trading, that is gambling. So please do not use that. Yeah, they are susceptible to stop hunts, because if you're gamblers, and you know what gambling is, usually those matches, let's say you want to go on a football match and you want to place, let's say that, I don't know, Manchester United will win versus Barcelona. Some of those can be fixed, can be basically, I will say that in Forex terms, stop hunted. Don't do that. Forex binaries trading is definitely gambling. Okay? Stick to Forex trading You will be safe. If you trade as I teach you, you will know that you are protected. Because I want to protect myself, and what I do is I teach you how also to protect yourselves. Okay? We will talk about this more. Now we are basically entering a time when we should call it a day. Yeah. One more question. Yeah, Law. But if there were stop counts, technical analysis becomes not valid. Don't Law. Don't be so afraid of stop counts. Don't be so afraid of stop counts. You know how technical analysis is valid. Look what happened today with my dollar CAD analysis. I need to switch again to my dollar CAD analysis. Okay. Dollar CAD today. This was valid analysis because you see the price. After my analysis, the price came here and jumped. Came here to basically this level here. So most of the time you will be right. You will be right with trading. And yet again, there is no stop hunting. There is just some stops being collected here. But still dollar CAD is bullish. Okay? So don't be afraid of stop hunts. Technical analysis is valid. But you need to know how to protect yourself, guys. It's not just about placing your trades and going out. You need to know when, where, and which pair. Dollar CAD was pretty much good for me today, and I will still buy into dips on dollar CAD. Euro Swiss is good for me. Euro dollar is great at the moment. But I will stay away from, I don't know, dollar maybe, I don't know which pair is acceptable. I don't see any potential chances for some stop hunts now at the moment. Especially because those big bands are fine for those kind of movement. So don't be afraid. Just relax, trade as I teach you, and put normal stop loss with low risk. ECB, I don't know. I don't have any opinion. It might be very dovish, so the price should hit 22.80. Okay? Yeah, you can ignore the spikes. Just leave it. I lost the trade. Leave it. Don't be upset. Use low risk. Don't be upset. Yeah, I can have a webinar. Mike is asking, can you have a webinar sometime longer held position like based on 4-hour chart? Yeah, I will definitely use that, but that is more of intra-week trading. I will do that, definitely. On subject of stop hunting, are there some pairs that are worse than others? US dollar pairs are mostly susceptible for stop hunts. Because US, you live in US, Mike, you know that US dollar is safe haven. You know that US dollar is definitely most traded currency, US dollar. So please, do not be afraid so much. Trade euro dollar, trade dollar crosses. Dollar yen, yes, definitely dollar yen. Dollar yen can be pretty much susceptible, but it wasn't the case now at this moment. Euro dollar is very susceptible because the euro is very much traded as dollar is. So euro dollar, dollar pairs and such. Okay guys, I see that you enjoyed the webinar. We can call it a day. Thank you guys for this. Please ask Admiral Market Support if they will upload this webinar. I hope that will, because it's pretty much useful. Thank you for attending the webinar. Thank you for listening. I will be here with you soon, guys. Relax and trade safe as always. Cheers.